Hi, welcome everyone. Thank you so much for joining us today. We're really excited to have Klaus with us again today. As you probably saw, we are recording this. So if you don't like to see your face on a recording, you can take yourself off camera, and that's totally fine. Or if you need to eat your lunch, please take yourself off camera if you need to. And also we have you all on mute. So please keep on mute. We're gonna do questions at the end. And so just if you have questions, put them in the chat or yeah, put them in the chat and we'll go over questions at the end. And again, we're really excited to have Klaus talk to us today. He's been talking to us as a group for about 15 years, which is fantastic. And he is so smart and has really great things to say. He has been at Fidelity for a long time. He's now independent. So you'll hear Klaus as an independent Klaus talk today. So we're excited. So welcome, Klaus. Thank you. And pass it over to you.
Thank you, Amy. Thank you, John. Thank you for having me. Let me just pull up my presentation and then we get started. So can everybody see this? Does this work? Perfect, great. So good afternoon, everyone. It's a pleasure to be on here. Amy has asked me to speak for about 30 minutes on the current investment environment, and then we open it up for questions. I don't really want to talk about the election, but we have to a certain degree. So I'm going to start with the election here. And I know that many of you might be still concerned about sort of the outcome and maybe angry and worried about the outcome. And let me just say up front that that in general, there's nothing here that I can tell you that will make you feel a lot better, with the exception about sort of the outlook on the economy. I think that is really an area that I would not worry about, because first of all, because of history. We have now a history of about 100 years of equity market returns. And you can see this on the chart here. On average, over those 100 years, the market has returned about 10%. And with the exception in the beginning of the Great Depression, you can see that through Republican presidencies, the market has pulled through, and not only through these different presidencies, but also if you sort of think about the kinds of events that that we as a society had to go through over those 100 years. You had the World War II, you had the Vietnam War, you had the oil crisis, you had the great financial crisis, you had the internet bubble, you had COVID, you had 9/11, you had the Iraqi wars. I mean, you had sort of one problem, one crisis after another, and sort of the markets always have been pulled through. And I would argue they will pull through this situation as well. And if you sort of think more deeply about it, sort of what is the track record of different presidencies and different permutations about the House and the Senate, you can see that that in all of these 6 different possible permutations, the market actually has returned positive numbers. And the one that we are dealing with right now here is a Republican president and a Republican House and Senate. And you can see on average, the returns have been about 10.7%. From a financial perspective, that's a number I would gladly sign up with. Some of you might sort of look at this and say, well, this is one of the lower numbers. And it is, but if you go further back, this takes you back to 1949. If you actually go back to 1933, these numbers are basically sort of almost identical across the board around that 10% number that I mentioned. And so there's nothing in our history to suggest that sort of this kind of permutation has a really, really bad history, nor that sort of the presidency itself has that much influence on the equity market. And the reason for that is that the president is actually not as powerful as you might think it is. The president is very much constrained by laws and by the environment. And I just want to talk about this a little bit because I think it's important. The first constraint is that there's already another election in 2 years. 1/3 of the Senate is up for re-election, and the whole House is up for re-election. And if you sort of think about what happened to the US since the great financial crisis, what is really interesting to note is that in the last 10 elections since the financial crisis, the party in power has been kicked out. In 9 out of the 10, whoever was in power lost the next election. The only exception was President Obama. And if you think about it, sort of why might this happen? And by the way, this hasn't really just happened in the US, it happened globally, has been a global phenomenon. And the reason for that is that the developed world everywhere is dealing with the same issues: post-industrialization, automation, migration, climate change, older demographics, high deficits, inflation, low income growth. These are difficult issues that the president of the US deals with, but the president in France, Germany, Japan, they have all these issues as well. All of them have lost over and over again their election. And so it's actually sort of not that big of a surprise that you would have a change election here as well. And the reason why you have these change elections is that nobody has actually been able to solve these issues. And so the problems remain the same. And the electorate sort of, it gets frustrated after 2 years and says, okay, that didn't work, we try something else. And if you sort of think about what's going on here right now, and sort of, I've read already 2 articles by relatively conservative people who said sort of the ingredients of Trump losing 2 years are already seeded here, because it appears that he's doing more what Elon Musk and his billionaire supporters want to do than what the people who elected him actually want. And let me just sort of talk about sort of Elon Musk wants to cut $2 trillion of the deficit. None of the people who voted for him really wants that, because it would be devastating to the economy. And so it's interesting to see that this is already sort of starting to be a problem maybe for Trump if he doesn't deliver on these things. And the reason why this is a problem is that he has very, very thin margins in the Senate and in the House. In the Senate, he has a majority of 3. But there are what most Republicans would consider now 4 moderate Republicans out there. You might not necessarily like those names, but if you look at the whole Senate, they are quite moderate and will sort of stop some of the ideas. Susan Collins, Lisa Murkowski, Mitch McConnell, and Mitt Romney. And so that is going to put a constraint on him. The filibuster is going to constrain on him. And he has to go through the process of getting his candidates confirmed. And he's talking about recess appointments right now. This is actually a lot more difficult than it seems. And ironically, it's more difficult because the Senate actually has made a ruling that a recess appointment can only be done if the Senate is not in session for more than 10 days. So the Senate has to be out of session. And over the last 4 years, basically since the ruling, the Senate has always made a point to stay in session. And so that is likely to continue. And so the recess appointments might be quite difficult here as well. Also, I should point out that the Senate map in 2 years from now looks more favorable to the Democratic side here as well. So that is going to put a constraint. And it's the same what I just said for the Senate of being a slight majority, sort of slowing him down. It's also true for the House. We don't know exactly what the majority is, but what we do know is that he has already picked 3 members of Congress to serve in his administration, and they're going to leave Congress. Matt Gaetz, Elizabeth Stefanik, and the National Security Advisor are all going to leave Congress, and it will take between his majority there. And in addition, he will have also some relatively moderate Republican Congress people from California and New York that he has to deal with as well. So all of that is sort of putting a little bit of a constraint into what his degrees of freedom are. The third one is that there's an existing framework of laws and regulations. That again, there's an irony here that the Supreme Court has narrowed down what the administration can do. You might recall that about 9 months ago there was something called the Chevron ruling. That was a ruling where the Supreme Court said that regulation couldn't, in all cases, be just come out of the administration. They have to be actually acts of Congress, and that was designed to stop the Biden administration. But the irony is here that it's going to stop and slow down Trump here as well, because he has to adhere to these rules as well. Then there's the equity market and the currency markets, who also are going to constraining factors. Some of you that I see have been around when James Carville was running Bill Clinton's campaign. He said that sort of the most powerful force in the world is the bond market, and he was not far off. The bond market is going to sort of majorly, and the equity market are majorly going to influence sort of what this administration does, and put a reality check on it. And the last time the equity market really checked the administration, the last time I can recall, was during the great financial crisis. I know that's some time ago, but you might recall that during the financial crisis in 2008, Congress twice failed to pass a stimulus package in the morning, and then the equity market crashed by 800, 900 points, and in the afternoon, this legislation passed. And so I read already how Trump is not putting certain people forward for trade or for treasury, because he knows the stock market is not going to like those. And again, it's a constraint. But the biggest constraint, and this is what I want to talk about today, is actually that a president has to deal with the world. And it sort of throws problems at the administration that they have to deal with. If you sort of think about the last year and a half of the Trump administration was defined by COVID. And there was certainly nothing that he wanted to deal with, but this is what the world gave him. And from an economic perspective, what I want to talk here about now is what Trump has to deal with is the economic cycle. And many of you who have been with me for 15 years have seen this chart before, but the US economy and basically every developed world economy has a certain rhythm to it, a certain cycle that repeats itself. It's basically sort of a boom to bust cycle that lasts about 7 to 8 years. And for the best way to think about sort of a cycle like this is, and I realize that none of you drink, but it works basically like a hangover. So if you think about sort of a hangover where you might have had too much to drink on a Saturday night, and then you wake up in the morning on Sunday morning, I'm sorry, with a big head, and you feel bad, and you might say to yourself, oh my God, this is so bad, I'm never going to touch another glass of alcohol in my life. And then you start sort of feeling better during Sunday. afternoon, and but you still remember it Sunday night. You still remember how bad you felt in the morning, and you don't have nothing to drink. And then on Monday, it's Monday Night Football, right? So you might have a glass of beer and maybe a second one, and then you wake up on Tuesday morning and you still feel all right. And then during the week, you work yourself back into Saturday night, and the cycle starts over. And this is basically the cycle of the US economy. It works like that. And sort of Saturday night is basically the time in the economic cycle when we all feel great. Our 401k has grown significantly. We feel good about our job. It feels very safe. We just get a big bonus. We just get a big raise. And we start to buy maybe the extra cars, take the extra vacation, maybe sort of be in the market for a bigger house. And mostly how these things work is if we feel good, our neighbors feel good as well, and everybody sort of spends a little bit more money money at the same time. And sort of with this big demand coming up, there's not enough supply who can actually sort of fulfill these wishes. Because of that, prices are going to rise. When prices are rising, the Fed raises interest rates. And the rise in interest rates then leads to a slower economy, leads to a recession. We end up with jobs that doesn't feel that safe anymore, with 401ks that has shrunk a little bit, with a lot of credit card debt. And for a couple of years, it's Sunday morning, and Monday we're starting to save a little bit more, pay down our debt, and then we work ourselves up again. This is sort of how the cycle sort of works sort of in real time. And if you go through our current cycle really started during COVID. And what happened during COVID is, if you recall, and sort of you can see here, the inflation rate is a 1 in the doubled red line, and the blue line is the Fed fund rate. So this is the interest rates that the Fed put out there. Is sort of in COVID sort of is that it's in the beginning of 2020, so it's where that gray bar is there. And so what happened was that we all remember that, right? During COVID, we were locked down in our house, couldn't spend money anymore. There were plenty of transfer payments coming from the government. And then all of a sudden there was a vaccine, and we could all go out and spend money again. And when we all went out at the same time, were able to spend money again, it wasn't enough supply. So there were supply chain issues with China. There were labor staffing issues in the travel industries, and you had an increase in prices. And prices sort of shot up here. You can see this in this rate. We all experience this. And the Federal Reserve Chairman Powell waited a long time before he started to raise rates. And looking back, it was a mistake. But he thought, oh, this is all transitory. As soon as sort of people have normalized, the supply chains are open again, people come back to work in the restaurant industry, we'll be fine. It turned out not to be the case. He had to raise rates very, very aggressively just to bring inflation down. And so we are still now at a point where interest rates are very, very high. Mortgage rates are about 7%. The rate on credit cards is about 25%. Small business loans are about 9%. And these are rates where normally housing starts, investment by businesses, and consumption by you and I slow down so much that we go into recession. In a normal environment, we would have been already in a recession here, but we didn't go into recession yet. And the reason why we didn't go into recession yet is twofold. The first one is that again, during COVID, we had a very, very high savings rate. On average, the savings rate in the US is just barely over 6%. That is, people save about 6% of their income. But during COVID, you can see this rate jumped to 24%. So people saved a boatload of money. And if you translate this into actual dollars, coming out of COVID, Americans had accumulated $2 trillion more in savings than they historically had. And so when the Fed started to raise interest rates, it didn't really matter that interest rates were becoming that high because people sat on $2 trillion worth of money and they worked this off. But now we are, and sort of that kept the economy going. But we have reached now a point where that excess savings is gone. So that's a little bit of a concern that the extra savings are not there anymore. And you can see a little bit of stress already in auto loan debts. You can see a little bit of stress already in credit card debt. And so they're becoming emerging, some weaknesses coming out here. The second reason why we haven't gone into recession yet, and this is a chart that looks at labor supply and labor demand. Labor supply is obviously the amount of people who want to work, and labor demand is how many job openings there are by American businesses. And if you study this chart very, very closely, what you'll find is that there are only two periods in the history of the last 100 years where actually labor, I want to make sure that I said this right, where labor demand is not bigger. I'm sorry, where labor demand is bigger than labor supply. There are only two times where there was more demand for labor than there was actually supply. The first time, and that lasted a very, very brief short period, is just during the Vietnam War and the Korean War, and that is for obvious reasons. Actually, that's the Korean War, I'm sorry. And the second time is during COVID. And so the labor market was extraordinarily strong coming out of COVID, given sort of the unique labor supply and labor demand issues. And what you need to know about the American consumer is that the American consumer spends money as long as they have a job. So having this excess amount of savings plus having a very, very strong labor market allowed the American consumer to ignore basically the high interest rates, and it just could plow through it. But we are reaching now a point where the labor market is sort of starting to weaken, and you can see this in these numbers here. These are job openings. They have dropped significantly, as you can see. These are quits. These are the amount of people who quit their jobs, and you can see this is viewed as a sign of confidence. You quit your job when you're really confident that you can find another one. You don't quit your job when the labor market is very, very, very weak. And sort of you can see also here in layoffs that have increased. None of these numbers are scary yet, by the way, but you can see the trend. And this is what I'm a little bit worried of, is that, and some economists are also worried about, is that when as this economy is sort of normalizing again and interest rates are staying high, and they are still high, that we might go into a recession. You might have heard the terms hard versus soft landing. And this is sort of really what it describes as the soft landing is a hope that when the Fed is raising rates to fight inflation, when inflation comes down, the Fed is able to take inflation down fast enough to not crash the economy, to not go into a recession. A hard landing is the Fed is not able to bring rates down fast enough, and we end up in a recession. And what I tell you, the history normally shows that we go into a recession. Having said all this, at this moment in time, this is not a very satisfying answer, and so please bear with me. So I would say it's almost 50-50, or we have a hard or soft landing. There are good reasons to believe, and I've shared some of it with you, why we might go into recession, but but the economy also sort of shows surprising strength still, and it may end up just being a soft landing here, and we do fine. And sort of you could have two very, very different financial events. A recession obviously would be bad on your equity returns, but if we have a soft landing, and by the way, the last soft landing that we had was in 1994. And some of you might remember how great the times in 1994 were, particularly in San Francisco, where you had 95, 96, 97, 98, just before the internet bubble. These were tremendous times. And so it's really sort of a time where this can go either way. And I would also argue that going back to my earlier point, however this plays out, and it's going to play out in the next 4 or 5 months, I would say, President Trump will have nothing to do with it. He will either get very lucky that the economy has a soft landing, or he gets very, very unlucky that he gets a recession. But that this is completely up in the air. The other risk that I would like to point out here is 100% in his control, which is that his policies could reignite inflation. Let me just, before I go why, let me just tell you what has happened in the interest rate environment here in the bond market. And I apologize for this technical charts, but I wanted you to see it. This is the 10-year Treasury rate, okay? And so if you go back, it was almost zero. During COVID, it was very, very, very low, and then it sort of started to rise again. It topped out at 5 when inflation was very, very high. Then the Fed started to raise rates, and the inflation rate dropped, and it dropped to about 350. And then Trump got reelected, and all of a sudden, interest rates went from 350 to 450 again. They rose by 100 basis points, by 1 full percent. Doesn't sound like a whole lot, but this is a huge move for the bond market. And the bond market is getting nervous that Trump's policies on immigration and on trade and on tariffs are going to cause inflation to spike again. And the reason that the bond market is afraid is that there's a history that if you raise tariffs too high, that you actually end up with a lot of inflation. And I don't know why I always have these examples that are related to alcohol, but you might recall that Trump raised interest tariffs on European wine during his first presidencies, and wine prices from Europe exploded because of that. I mean, it's just if you put a tariff on every good that comes into the US, eventually sort of this is going to raise prices here. So that could be an issue if what kind of tariffs he puts out there are very, very targeted to certain industries, maybe just to certain countries, and it's very well calibrated. I don't think it's an issue. But if he overdoes it, it is going to cause inflation, and it's going to cause the Fed to not lower rates, but increase rates, and with higher interest rates, the likelihood of recession is going to increase. Immigration is sort of the same issue here. If he sort of closes the border down and for a while, we would have no more illegal immigrants coming into the country. That's probably something that would not be inflationary. But if he starts off the 11 million illegal immigrants, if he starts to deport many of those, it could be an issue because most of those illegal immigrants are actually working. And they're working in agriculture, they're working in construction, they might do your yard work, they work in restaurants. And so if we start to deport those, a lot of these services could become more expensive and also, again, sort of lead to inflation. And again, it's sort of it depends on the calibration here. If he sort of gets it right, gets the right level of immigration enforcement, gets the right level of tariffs, we should be okay. But again, if he overdoes it, we might have an issue here. And so we are sort of in an investment environment where I would say it's to you is this is not a great time to take big risk. And what I mean by this is I don't mean with risk is the risk that you take investing in equities. What I mean with your risk is the risk that you would take when you deviate from your financial plan. And your financial plan is a plan that you've developed with your advisors that considers sort of your personal situation, your risk preferences, your income, and your dreams and desire. And that plan I would definitely stick to. And I would actually sort of follow this plan right now almost to the T and wouldn't deviate from that plan because in the situation where there's great upside risk and great downside risk, depending on how the economy goes, depending on how extreme, if you will, or moderate trade policy is and immigration enforcement. And so you want to sort of just stick with your plan right now. Don't lean yourself in one direction too strongly, because the portfolios that you have built with your advisors are basically designed to basically take advantage of the upside, but protect you to the downside. And you want to have both right now. You want to have as much upside opportunities that you can, but you want to keep that downside protection that is in your plan embedded as well. So I would not take a whole lot of risk versus sort of your financial plan here. And just sit tight. And I would say probably in 3 or 4 months, and hopefully Amy and John will have me back here with you, we see a little bit more clarity on sort of the economy and more clarity on Trump's policies and tariffs and immigration. And maybe then we'll know to take either on a little bit more risk or be a little bit more careful. But at the moment, I think you want to have a portfolio that is sort of carefully balanced for both outcomes. So let me stop here. That was about half an hour, and see if there are any questions or comments.
John's going to help us field through the questions. John, do you want to ask the first one?
Sure. Yeah. Actually, just a follow-up to what you just said. And there's a question here from Idan. Hopefully I pronounced one of those wrong, but I apologize.
You nailed my name right. Perfect.
Hey, Dan.
You want to just ask your question? Go right ahead.
I think it's partially answered already. So, I mean, I asked that question sort of a few slides before that last slide, Klaus, and I'm saying, so, what's the equity investment strategy when you want to protect yourself from the downside of a hard landing while not losing out on the upside of a soft landing? I mean, yeah. And you kind of addressed it a bit on the slide, but basically you said stay the course. Is there any other advice you'd give?
Yes. I mean, look, you have a financial plan that you've developed with your advisor based on sort of when you want to retire, how much sort of risk you can take on, and I would, when you feel really good about the future, you want to take more risks than your plan because you feel like this is a fair pitch. You want to go in. If you're in an environment that is more uncertain, you want to sort of deviate from the plan and be more safe. And here, because this could be 94, right? I mean, this could be 94. I mean, think about what did we have in 94? We had a soft landing. We had a new technology that was the internet, and there was all this excitement that sort of this would transfers into a new world, and it worked great for 4 or 5 years, and then it sort of crashed. But sort of you wouldn't like to miss out on those 4 or 5 years, and so there is sort of the potential. This is 94 again, and financially we will do really well going forward. And so you want to sort of be a part of that and have at least part of your portfolio participate in this. But on the other hand, the rule is after the Fed raises rates, right, that you go into recession. That's unfortunately the soft landing is the exception. And so you don't want to put everything on the exception. You want to sort of balance this out, and that's where you want to have the other side of your portfolio protected as well. And you just have to sort of carefully calibrate it based on your personal situation.
That's good clarification. So you're not necessarily saying take risk off the table. You're just saying don't take undue risk.
Yes,
Yeah.
so when I thank you, John, for highlighting this again. When I say stay neutral, is stay neutral to versus the plan that you've built, right?
Yeah.
Versus that's what I meant by neutral, not take everything in cash. That's definitely not what I'm saying here.
Yeah. Dave has a good question around clean energy, and maybe you can even expand that to just ESG investing too. You could answer directly about energy, but then maybe expand on ESG in general. Is there an investment concern in terms of clean energy based on the possibility of fewer tax subsidies and possible tariffs? It appears that current climate may not be amenable to this industry.
Well, this is certainly this is where one of my points was that in a sort of macro perspective in the S&P 500 overall, whoever runs the government doesn't really matter that much, but on a sector level it does matter. On a sector level it does matter, and so there are winners and losers on a sector level. And the one of the losers is in all likelihood sort of the alternative energy group. That's probably a group that will lose some of the subsidies. Although it's a little bit unclear to me why Elon Musk, who runs a EV company, sort of wouldn't want EVs to be subsidized going forward. So I'm not 100% sure if that really sort of plays out the way everybody thinks it will. But sort of this is probably an area of that is not going to do that well under President Biden, and sort of, but it's already reflected a little bit in the stocks. I mean, the solar panel makers, I mean, they have been hit very, very hard since the election. And so it might be sort of too late to adjust your portfolio here, but that's probably one of the areas that is going to, again, being loser. Having said all this, I mean, climate change is going to be an issue for the world going forward. And the only way to mitigate sort of the change in temperature will be an increased use of alternative energy. And so it might be not subsidized over the next couple of years as much as it has to. It might be a little bit tough period in the short term here. I think in the long term, we are going to get out of coal. We're going to get out of oil. There's just no way around it. And sort of these industries are probably in the long term are going to win out, but in the short term, they're probably a little bit impeded by the policies of the administration.
Next question was from Artrice asking if you see the impact of Project 2025.
Well, Amy, sort of that's less of an economic question, more of a sort of social question, if you will. Let me just sort of answer it this way, all right? Okay. And just let me just repeat myself what I said earlier, because I think that is really important. That in the last 9 out of the last 10 elections, the party in power has lost. And this has not only happened in the US, but it happened in the UK, it happened in France, it happened in Germany, it happened in Italy, it happened in Japan, it happened in Spain, it happened everywhere. It happened because the the party in power didn't solve all the problems of the world, of slow growth, climate change, wars all over the place, immigration, deficits, bad demographics. And this is what I tell my wife. She got really mad about Getz and Kennedy and stuff like that. And I told her, would you be happier if he nominates people that would get that would make him successful? And she said, no, I don't want that either. So what I'm trying to say here is that that this Agenda 25, as far as I can see, is not fixing any of these problems. All right, it's not fixing any of these problems, and so I don't think that is the winning agenda for the Trump administration. And Trump really has to make a choice here. Is he going to try to fix the problems that the people who elected him want to get fixed? Or is he going to do what his donors and Elon Musk wants him to do? And these are very, very different. And if he goes with the Musk and the donors and the 25, this is not going to be a winning administration they're going to lose in 2 years. And right now, it seems where he's going.
Great. Next question. We'll go a little out of order here, but we'll get to all the questions if we can. Kim asked about AI investment, Klaus, and she's essentially asking, is that something good to add to the portfolio? I mean, anybody that's invested in any growth fund is very, very likely to have AI investment in it. But maybe you could answer that question and talk generally about AI and the impacts on the economy.
Yeah, let me just make maybe two points on AI. The first one is, and I think that's really sort of an observation that rings very true to me, is Bill Gates used to say that we always overestimate the impact of a new technology over the first 2 years. We overestimate that. And over the next 10 years, we underestimate, meaning that these technology take a lot of time to actually sort of play out. And it feels to me that we are just in this period where we are almost 18 months, 22 years in, where people are thinking, oh my God, maybe AI is not that important. Maybe sort of where's the revenue, where's the growth, where are the applications? We're exactly at the point, sort of our expectation what AI would do 2 years in were too high. But I think what AI is going to do for the next 10 years is that expectation is probably too low. And so I do believe that AI is going to be a tremendous investment opportunity, and maybe even right now, where sort of a lot of these stocks have been sort of knocked down a little bit. Having said this, if you would ask anybody at Wall Street right now, who are the leaders in AI, they would all say NVIDIA and Microsoft. NVIDIA on the hardware, Microsoft on the software. If you would have asked anybody at the beginning of cell phones, who were the leaders in cell phones, people early on would have said BlackBerry, Ericsson, and Nokia. If you would have asked people who were the leaders in 1990 in the internet, they would have said Netscape, Lotus, WordPerfect, AOL. My point here is whoever is the leader now might not be the leader going forward. And so what you have to do, if you want to invest in that space, cast a really wide net, because we don't really know how this is going to play out. But I do believe that it's worthwhile. Everybody should have and will have, if they have index funds. You probably have, all of you have AI investments more than you think in your portfolio. You're probably not underinvested in AI. Some of you might, but you're probably not.
Next question is there a scenario where we have both inflation and recession? And what does that mean for financial planning?
That is possible. We haven't had that a lot. It's sort of more an unlikely scenario at the moment. I could see this happening for maybe a very, very short period of time, and that would be a period that would not be good for the financial market. But again, I think the bond market and the equity market would put so much pressure on the administration to change course, and they would. I mean, sort of think about it. Who's the people? I mean, most people on Wall Street, let me just step back for one. I think Trump wants to be a successful president. All right. You might not think that he can, but he wants to be a successful president. And the way he measures successes is his approval rating, is what the equity market does, what the bond market does, and what his billionaire friends say. All right. This is how he measures his success. And within that group, he wants to be successful. And so he doesn't have any core beliefs, if you will, other than he wants to be successful. So if some of his policies lead to his billionaires' friends and the equity market and the bond market losing a lot of money, I can see him correcting course like this. And so I see this a little bit of a risk, but not that big of a risk, because he is not an ideologue who wants to sort of go a certain policy because he believes in the policy. That's not his. He wants to have short-term success. And so from that perspective, I don't think that risk is there.
Great. Steve says, I'm concerned that Trump's regime is going to be completely chaotic, worse than the last one. It seems to me that this represents an opportunity to China and that we're on the brink of a historic change in the global balance of power. If so, what might the implications on a mainly US-based portfolio be?
So first of all, I would say that China has more problems than we have, by far. If you sort of, let me try to sort of, I've gone through my mind sort of how do I explain the problems in China. The problem, the basic issue in China is that you have very, very poor demographics. All right, you have a one-child policy. There was an article, I think yesterday, that pointed out that China's population was over the next 10 years, I believe, is going to shrink by 60 million people. China's working population is going to shrink by 200 or 300 million people, actually. And so there's a demographic issue that's going on. It just doesn't have enough workers going forward to grow. That's one. Number two is China doesn't have a social net. Okay, there's no safety net. There is no unemployment insurance. There is no social security. So people have to save. And they historically saved money by investing in real estate. Real estate has been completely overbuilt in China, and people have been losing money in real estate over the last 5 years. So none of the Chinese right now is investing in real estate anymore, which was also a big source of economic growth and employment. The equity market, another possible investment vehicle for Chinese savers, has been basically flat and down for the last 10 years. So the Chinese are not investing in that either. So what the Chinese are right now doing is basically saving a lot of money and keeping it sort of in savings accounts or at home or in gold. And the government, and because of that, the economy is not growing. The housing sector is in deep disarray. because there's no further, it's completely overbuilt and there's no further investment coming in. The equity market is not doing anything. And so the Chinese government doesn't know what to do to get this economy going, because to get the economy going, it probably needs to put in a social security system or a social net in there that gives the Chinese consumer the confidence to spend money again. But they don't want to go there because it would be incredibly expensive. And so they're basically stuck right now. The economy doesn't really grow. They have huge problems demographically from an economic perspective. And so I don't think the Chinese government is going to be, the Chinese are going to be a threat to the US at all, or an opportunity. If you go around the world, look, I'm from Germany. I mean, Germany has its own issues. Okay? There's nothing that I would say, oh my God, Germany is sort of on or Europe is on a trajectory that they could sort of challenge the US or would do better than the US. You go country by country, there are not a whole lot of countries that, even if you sort of think about this world is going to be chaos with the Trump administration, that seems to me functioning better than us right now. And so I can understand sort of the idea that these are problems and this might not be the most functional administration that we would like to have. But I also think that compared to the rest of the world, we will be still in pretty good shape.
Dave asks, what about the impact of the Inflation Reduction Act, the CHIPS Act, and the Biden policies to invest in infrastructure?
So these acts are actually, they're a little bit like the Obamacare Act, right? For decades, well, decades is an overstatement, for years, the Republicans wanted to abolish this thing completely. And then it started to become very, very popular. And now the Republicans are not talking about getting rid of Obamacare anymore. And to a certain extent, it's happening to the Inflation Reduction Act as well. Lots of factories are going to be built right now. There are factories being built in a lot of these towns that actually have lost factories. And so there might be some changes on the margin, Amy. There are sort of certain provisions in this area are going to be cut, but in general, these things are just too popular, and I think are going to be maintained.
Okay, you touched on this topic a little bit earlier, Klaus, but Gerard is asking if you're curious, or he's curious, if you think that the quote unquote government efficiency initiative / firing hundreds of thousands of civil servants is a significant risk factor for broad economic disruption.
Well, it's all about the degree of which. Let me just say it this way. It's all about the degree of which. I think we probably can all agree that that in certain areas of the government might be a little bit bloated and could work better than they're working right now. I think we would all agree with that. And if this agency is going to sort of step in and make some carefully calibrated cuts, this actually could be good. I mean, it sounds outrageous, but I mean, there are certain opportunities there where this might actually be an opportunity. But the risk is obviously that this goes too far. And again, where I think this then stops is when the equity market and the bond market sees that this is going to be so far that it's becoming dysfunctional, and you will have a relatively violent reaction in the markets based on sort of some announcement. And after that announcement is then sort of reflected in very, very bad equity returns or in very, very bad bond returns, Trump will fire whoever did that and say that was never my intention and move on. And so I could see headline risk and maybe a little bit of short-term risk. But again, I mean, one of the things that Trump can't take short-term pain, right? I mean, he needs instant gratification, and so so if any of his policies cause instant pain and instant strong pain, I think he is more prone to reverse course than probably anybody else out there.
Maybe this should be the last question. We're running out of time, but Heidi asks, is it best to make big purchases like a car, appliances now, or wait and see if, a recession drops prices? COVID didn't drop price of these kinds of things. In fact, they raised them.
Yes, this is a good question. And you could talk me in either direction, Amy. You could sort of talk, you could tell me that on the one hand, I could say, look, I want to buy it now because most of these things are coming from overseas and coming from China. The sort of you want to buy the washing machine or the dryer before these tariffs are put on.
Mm-hmm.
On the other hand, you could also see that, well, if we go into recession, those got cheaper. So I don't have a strong opinion on this. I personally wrestle with that myself, thinking, when do I buy an electric car? I mean, they seem to be sort of a glut of these cars, and I'm hoping, but I'm thinking that maybe I get it at a sort of a cheaper price point where sort of where these cars, because sort of it seems to going into hybrid right now. That seems to be sort of the car of choice, and sort of buy full electrical gets really cheap. And on the other hand, I feel like, well, the tax thing might go away, and so I'm twist and torn, and so I don't have a strong opinion on that, but it's a very good question.
What about investing in real estate?
That is a very, very local decision. That's a very local property decision. It used to. I mean, this is really depends on sort of where you are right now, and sort of certain areas of the country have recovered completely and are thriving, and certain areas haven't really recovered yet, but have a lot of potential. I would say San Francisco is probably an area that has not recovered as much as other areas, and might have potential of a full rebound, because I mean, I see some of the pictures you have in the back, the Golden Gate Bridge. It's a beautiful area, right? It's a beautiful area, and it should thrive again fully, but it hasn't yet. So you could see it sort of there, sort of a big opportunity, but it really depends on the property.
All right, we are right at 1:30, out of time, but this has been fantastic. You guys have even more questions, which means we need to do this again soon. Claus, thank you so much.
Thank you, Amy.
This was fantastic. You guys have great questions, by the way. Love it. Really good. Really nice to see all of you. Thank you so much. We'll do it
Thank you,
again
everybody.
soon.
Good luck.
Thank you.